My name is Eric Burkholder. I'm the founder and senior advisor here at Burkholder Wealth Management. And today we're going to do a video on the bond market, interest rates, and how bonds fit into your overall portfolio. So first, we'll start off with the breaking news that a lot of people have heard about recently, and that's that Moody's downgraded the US credit rating from this AAA perfect rating to the one notch below AA+. So that was pretty big news, but I think it's important to point out that this is the third and last major rating agency to downgrade the US debt. And so we've seen this before. It's not the end of the world. Interest rates have risen some, but again, this is not new. The first downgrade was in 2011 by S&P 500 or Standard & Poor's, and then we had Fitch downgrade the US debt in 2023. Of course, we'd prefer the US to maintain its highest credit quality rating, but again, this is just one factor in the overall market. And so I think my first point in this video will be, it's very hard to predict what will happen to fixed income and future interest rates based on single individual factors like the US credit rating or the Fed decisions that they make throughout the year. We've talked about the Fed decisions before, but just as a reminder again, those tend to be hard to predict what the long-term effects of the Fed decisions will make on the bond market as well. Certainly the short-term interest rates, so cash instruments and overnight funds that banks use to fund their operations, will certainly be affected by the Fed funds rate and the decisions the Fed makes. But longer-term fixed income instruments like treasuries or mortgages, there's not as much correlation, and it's actually pretty hard to predict. About a third of the time, longer-term interest rates move in the opposite direction of the Fed's decision. So again, a plan based on predicting where interest rates goes is often going to not work. It's very difficult to predict, but we do not have to predict where interest rates are going to have a good fixed income strategy for your portfolio. And so that's where I'm going to shift and now talk about how does fixed income fit in your portfolio and our portfolios, and how can you effectively invest in fixed income and not subject yourself to having to predict what's going to happen with interest rates going forward. And so with fixed income, the way we view it is the stability of your portfolio. We know long-term equities by far outperform fixed income on the vast majority of time frames. 10 years and longer, equities do much, much better. So that's where you want to have your long-term money. But for most people, certainly retirees, but even younger investors, you may want to have something that's more stable in your portfolio for expected or unexpected cash flow needs, or just to buffer some of that volatility of the equity markets. And so that's where fixed income comes into play. And our view would be, you want that fixed income piece of your portfolio to be very high quality and intermediate to shorter term, because that's where the safest bonds are, and that's the types of bonds that are going to hold up really well typically when the US equity or the equity markets in general don't do well. Some people use fixed income specifically for the yield. We think really it should be more of a combination, and your fixed income portfolio should match your needs, right? It shouldn't just be, we're going to buy bonds with the greatest yield because we just want to generate yield. You really should be looking at, what are your cash flow needs? When are those cash flow needs going to come? And then how much fluctuation in those bond positions are you willing to handle? Like anything, the more risk you're willing to take, the more return you should be compensated for taking that risk. But for bonds, really, I think your focus should be on high quality and low risk. So, and a good example of why that is, we've seen interest rates rise. And so if you were buying a 30-year bond and trying to get a little bit more yield out of a safe investment, that investment was actually for cash flow needs within the next year. Well, now that 30-year bond has lost value because interest rates have gone. The 30-year actually ticked over 5% for the first time in a long time. And so you now have losses you would potentially have to realize if you need to access that cash within, prior to 30 years when that bond matures. You really want to match up your cash flow needs to the types of bonds you hold. And so if you're looking at, covering expenses, either unexpected or expected, in a 3-year or less time frame, really bonds are going to be the best bet in your portfolio, because, and then the duration or the average time that it takes those bonds to mature needs to be 3 years or less, because we know if we hold bonds, or if you hold a bond fund that has a duration that's matching your cash flow needs, your principal value should stay intact. Now there are other things like reinvestment risk, opportunity costs, so it's not a free lunch. If you hold a bond till maturity, you don't guarantee that you won't. And just all practical implementation of bonds, you want to match the duration to the length of your cash flow need. And if you do that, those bonds should be pretty stable. They should maintain their value, and then they should be there when you need them. Beyond that, we're still believers and you need to put your longer term assets in equities. Take bets between equities and bonds or fixed income is just not a strategy that works out. It's very difficult, again, to predict fixed income, the direction of interest rates and bonds, and even more difficult to predict the equity market. So match your portfolio to your needs, shorter term needs, fixed income, high quality, and the duration should match the timing of your cash flow needs. And then for those longer term future cash flow, 10 years and out, certainly you want to put the odds in your favor and invest in equities that will perform much better. So in summary, although there's a lot of things going on in the bond market and interest rates right now with the downgrade and rising interest rates, we cannot predict what's going to happen over the next year or longer, but we don't need to. And that's okay. We can have a solid fixed income strategy without having to predict where interest rates go. If you need any more help or advice reviewing your portfolio or seeing where your fixed income allocation is and where it might need to be improved or tweaked, we're here. We're happy to answer any questions. And thank you for listening to the video, and we'll see you on the next one.